And I'm going to pass along with you today just a couple of rules, little insights. I call them rules, but they're really more of just experiences and insights and tidbits of things that common mistakes that I see people make when managing capital and actively trading the markets. Whether you are an active trader, somebody that's engaged on a day-to-day level, or somebody that's I'd say passive yet active, meaning you make maybe a few trades a month, that kind of thing. But you're actively managing the markets. You always have an eye on your portfolio, and that's the specifically where I think my expertise comes into play. So I'm going to jump into it here, and let's see. So we'll start with the disclaimers, which you can kind of just skim over and read, pretty much standardized. I start every presentation that I do when it comes to trading with basic, some quotes, and these are all quotes that I have, things that I like to keep carrying in my head, and I put them all around my trading monitors. I have forever. If you actually see my trading station, you'll see little quotes and bits of information kind of taped all over the monitors, and this is one that stands out for me, and it's a quote from Michael Jordan, and I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to make the game-winning shot, and I've missed. I've failed over and over again in my life, and that is why I succeed. And I think the beauty in that is that, as a trader, from my experience in working with individuals, it's so focused on the things you do well and the trades you get right. And I think where the mistake is really in trying to evaluate your mistakes and focus on the things that you don't do well, because the things you do well will always fall into place. And if you look at Michael Jordan and all that he's accomplished, the thing that he says here is when he looks back on his career, what comes to mind is his success as a result of his failure. So and I think that's very, very true in trading. Every night when I review my portfolio, and and I'll get into that a little later in the presentation, I tend to focus most of my time on the trades that aren't working well, and how to handle the risk associated with the trades that are what we call losers. Okay, so let's get into some of the insights here, and hopefully, like I said, if I can give you a little bit, you take away one thing from this presentation. In trading, the beauty of one thing is that one thing can potentially make you a lot of money because you've learned something new, or it'll save you a lot of money, which in turn can make you a lot of money. A little bit about me. Like I said, I've been trading since the 90s. I'm the CEO of T3 Live. I've been a trader for, or what I call a risk analyst, for about 17 years, and I really fancy myself more as a risk analyst than a typical trader. Although I do buy and sell securities, and that's what traders do, my time is spent analyzing and understanding probabilities and risks of the trades that I execute. The actual buying and selling, to me, is the easy part. That's just patience and having a good plan. The hard part is understanding the risks associated with what you buy and sell. I'm a managing partner of T3 Companies, which is the holding company for T3 Live, T3 Trading Group, and T3 Asset Management. I'm from Philly. I live actually currently not too far from Philadelphia. I live in the South Jersey area. I'm a graduate of University of Miami, and I have a great team on my side. And I'm not talking about University of Miami. I'm talking about my team right here. And these are the people that get me up to do what I do every single day. I have two little twin girls, 2 years old, and a 6-year-old boy. And just kind of humanize that I am just like everybody else. I have kids. I have responsibilities, I try to. And because I have those things, obviously they're great sources of motivation for me. But also, it's what I've found in trading is that the more you try to do, the harder it gets. And what I've learned in my years is that, and I've tried everything, and I'll give you kind of just a brief 30,000 look at my career. It started, like I said, in the late 90s, and it started in a time period that was very, very lucrative without having to know all that much about the markets. You could pretty much throw a dart in the wall and find a way to make money. Very, very different from the markets that we currently look at today. And I was a product of an environment, not a product of hard work. And for the first 3 years of my trading career, things were easy. And when all you know is that you come in every day and you turn on your computer and you can make money, it's a pretty nice way it's a pretty nice business to be in. When things changed, I realized after a certain amount of, a certain time period from, making high six figures and seven figures of income in a very short amount of time to making, literally $5,000 in 1 year. I learned the hard way that this business, there was a lot more to it than what I thought. And like I said, I was a product of environment, and I was a lucky one. And that experience was able to carry me through the time period, the darker period where I didn't lose a lot of money, but I just stopped making money because I really had no foundation. There was no art to my skill set. And the next 2 years, 2000, 2001, 2002, were really, really my learning years of training myself, teaching myself how to think, teaching myself how to wear my emotions, teaching myself what to buy, how to buy it, when to buy it. Pattern recognition, and really the science of learning to think in terms of risk and probabilities. The one thing I will tell you about trading, and most people, as much as we all know these things, the reality of it is, and this is again from my experience, is that when you are a trader and you are actively engaged in the markets, and you're buying or selling stocks or options or whatever asset class you dabble in, you live in the unknown. We don't know what's going to happen tomorrow. There's no guarantees of anything. You buy a stock with the intent that it'll go up and you'll sell it for a profit, but there's no guarantee. You can look at a chart every which way, portrait, landscape, upside down, inside out, 3D, 2D, and you might think that this trade is a no-fail trade because of, you can justify the reasons, but the reality of it is that there is no guarantee that the outcome will be as you presume or hope. So we live in a world of the unknown, and embracing the unknown is a very, very large part. And the success rate in the active space are never going to be that high because most people don't approach it with the right, the right mentality. They don't have the proper training, they don't have the technique, they don't have the foundation, and moreover, they don't have the mindset. And the mindset is, realizing that the unknown is the unknown, and that's the world you live in. And the way I explain it best, and the way I think most people can relate to it, is, you relate it to the game of blackjack. And the game of blackjack is such a simple game, right? Closest 1 to 21 wins without going over. And the game in the casino is such a foolish game because you're betting before you even have cards in front of you. So you'll put your chips in the circle. Essentially, what is your risk? Whether it's $10, $100, $1,000, or whatever the amount of risk you're willing to take on any hand, without really having any data to support, determining how how or why that's your risk. It's really with the intent of I hope, I wish, and I pray. If the game was played where you actually had cards in front of you, you had a 20, and the dealer had, let's say, a 5 showing, that's the hand where you would say, yes, this is the hand that I want to risk on. This is where the balance of power is clearly in my favor. The probabilities support that 7 or 8 or 9 times out of 10, this is a hand that I should win. Doesn't mean you're going to win. The dealer can go 5, 15, 21, and you can lose. But the reality of it is, if you chose to play that hand 7, 8, 9 times out of 10, again, I don't know the statistics of that particular hand, that you would most likely in the long run be a very large winner. Trading is no different. We think in terms of probabilities and outcomes, and we should only take trades that have higher probabilities of the expected outcome. There are no guarantees, like I keep saying, but it's a business of probabilities. So understanding when the setup is the right setup and the probabilities, the balance of power, as I call it, is in your favor, is when you should step into the arena and put risk on the table. And again, you still deal in the world of the unknown. You can't control or predict the trade. You don't get married to your trades. Let's see here. Let me just move some stuff around so I can see my screen a little bit better. And you can't avoid losing trades. But losing is a part of what we do. As I said, you can have a 20 versus a 5 and still lose the hand. You could think it's the perfect trade and you can still lose the trade. So living in the world of the unknown is detrimental, and being okay with the unknown, being okay that you're not going to bat 100%. You're not going to be right in every trade. Even the best traders are probably 50-50, and in a 50-50 result, you should still be highly, highly profitable. And it takes, for some reason, a lot of people can't ever get their hands around it. They might be able to talk about it, but when push comes to shove and money's on the line and they're in the moment of the battle of trading, they just lose the ability to think rationally about what they do. So while it's easy to say, yeah, it's, of course, be comfortable with the unknown, in the battle, I see I see too many people kind of just lose that idea and have it go by the wayside. So what do I mean by the unknown? Here's a chart, and again, I'm going to do a little before and after. It's like one of those infomercials where you see the person with the bad skin, and then they put the cream on, and then the after picture, or the heavy person that then turns into the skinny person. So here's the chart of a setup prior to engaging in a trade, and you can see, and again, this is just a random chart that I pulled from a trade, a while back, where the entry was a trade through 40.30. When that trade triggered, the stops were going to be set at 37.60, and the target of the trade was up to 47. So we had a good risk-reward ratio on the trade. Everything was outlined. You could identify why you're a buyer of the stock in this particular setup, and so on and so forth. Now, the unknown is what happens next. So we enter the trade, and then you get the outcome. As you can see from the follow-up, the after picture, over the course of the next 6, 7, 8 trading days, the stock trades higher. It hits our target at 47. We sell the stock. And then the unknown of that is that once we sell the stock, 15 days later, the stock's trading 70. It's still a great trade. It's still the right trade. We still did the right thing. You map out your trade. You have your plan. You execute your plan. You set your stops. You let your trade develop. And then you take your trade off, you make a nice trade, you move on to the next. So this is a great example of the unknown. We don't know the stock's going to go to 47. You don't know the stock's going to go to 70. You don't know the stock's going to, in this particular case, I think the stock, actually, maybe tipped 100. I can't recall. Somewhere in the high 90s, I think, is where the stock actually topped out. But nevertheless, you can identify where you want to be a buyer, where you want to be a seller, and what your stops are. I call that a perfectly planned trade. There's really no element or no stone that you're leaving unturned. Doesn't mean the trade's going to work. Doesn't mean it's going to go to 47. We can obviously implement, trailing stop tactics and other sort of, nuances to lock in profits when the trade starts to work. But from a, like I said, from a top-down view, this is what I mean about being comfortable with the unknown. Here's another example of a stock we bought. Again, a well-planned trade with an entry, a target, and a stop, and you can see the entry, and you can see the outcome here where we got stopped out. The stock actually broke out, reversed, and failed. So this is an example of why having that plan. So it's not that I'm just showing you stocks that work. I want to show you stocks that don't work, because what ultimately determines the stock trader's success over the long run is managing the losers. The losers that become massive, or you're not adhering to your stops, or you're not able to walk away from a trade saying, you know what, I like the trade, I did the right thing, it didn't work, let's move on to the next. If you can't just kind of wash, rinse, and repeat that model, it's always going to be a battle, because the losers, the ones that don't work, are going to clearly wipe out any good that you have on the other side. And I know that some of this might sound trite, and it might sound like chapter 1 of a trading book. This is so simple, this is basic, but it's amazing. It really is amazing how many people I see fail at this. There is beauty in the simplicity of this, and it's amazing how overcomplicated people make it, and myself included. It took me, 5 or 6 years to really understand that the simplicity of trading is, and somebody said it to me best early in my career, Evan, it's going to go one of three things that's going to happen. It's going to go up, it's going to go down, it's going to go sideways. And we spend so much time talking about indicators and oscillators, and it's almost, we make it this hocusy-pocusy kind of thing. And the reality of it is, if you understand basic technicals and you understand the language of price, and you can look at, again, what I call a foundation, where you can do time frame alignment, you can use multiple time frames, and you can evaluate the movement of price so that you can at least be able to say, this is a high probability trade, here's why. Once you get to that level of knowledge, which I'm not saying takes a week, it does take a little bit of time. Once you get to the point where you can look at a chart and you can identify, whether this is a high probability setup or not, then putting the trade on and letting the plan develop and letting the trade develop is the easy part. And that's that's kind of the approach that I wanted to share with you today. Here's another example. Again, a stock we were short. This is back in I think September. We were short EOG for a trade. Again, the entry was through 99.25, and I have it outlined here on the screen. The stop was at 102.60, and the target was down to 90 bucks. So again, a real good risk-reward setup. The trade is clearly the risk parameters are identified, the trade triggers, and over the next 7, 8, 9, 10 days, whatever it may be, we hit our target. The stock actually falls to as low as 80. We get out with a nice profit. We knew why we wanted to be there. We knew it was a high probability trade. It had good time frame alignment. It had some really good price movement. Basically, alluded to the fact that the stock was going to go lower. And typically when you're trading with a trend, and I define a trend by time frame alignment, both a weekly and a daily are aligned. And again, I'm not going to get into the full explanation of what that means. If you're not really aware of time frame analysis, time frame alignment, or multiple time frame alignment, it is a key aspect for determining high probability trades. I find that most traders that trade with a trend, meaning they're with a stock that has time frame, multiple time frames aligned, specifically the weekly and the daily, and we can get into it a little later in the presentation. You're going to go after what I call the low-hanging fruit. Doesn't mean you're going to have the, it doesn't guarantee you of an outcome, but you're going to be trading with the high probability situations. When you go against those high probability situations is when traders tend to get themselves in trouble. And I'm not saying you can't pick a bottom or you can't pick a top or be in a reversal type of situation, because you can do that, but again, those are trades that you have to have a very, very sharp eye and know what to look for in order to find success in doing that over and over and over again. Traders that typically short tops or look to buy bottoms as a methodology for trading over and over and over again don't last very long. For every one time you pick a bottom in a stock or pick a top in a stock and it reverses and changes direction, there's going to be 8 other trades that don't work. So reversal trading, although it can be highly profitable and can be very fast money, by and large is not, over the long run, a highly successful approach. Now, I'm not saying you can't do it or you shouldn't do it, but if you do it, understand the animal at which you're attempting to trade and understand the risks associated with it. And that's my my 2 cents there. So stocks that I'm showing you, like an EOG or a G Pro, and I'll show you others, are good examples of aligned time frames. Here's a stock that is a reversal trade, and this is a stock that actually, this is a weekly chart, and this is a stock that had a very specific setup on the weekly. We were short 668.75. The target was 595. We didn't achieve the target. We did take a little bit out of the trade, but not too much. And again, this is a reversal trade with a very, very calculated risk reward ratio off of a weekly chart with a pattern. So again, being comfortable with the unknown is a part of what we do, going into every trade with a plan so that you can clearly identify what the stop is, what the entry is, what the target is, and moreover, why those prices. It's not as if those prices that you just saw were just random spots on a chart that I picked. They had specific purpose and function, so I could tell you why, why the target was the target, why the entry price was the entry price, and why the stop was the stop. Why being the key marker for all of those pieces. So the plan is really not just entry, target, stop, but why those prices. Number 2, risk more when your win rate is high. Again, another simple fact. You don't arbitrarily risk a random amount on any given trade. And again, for sake of this webinar, we're going to use 2% because for some reason I feel like 2% is the amount people tend. That's the number that tends to get thrown around. So you don't risk an arbitrary amount, 2%, 1%, 3% on any given trade. It's a myth that risking a fixed amount on any given trade is the way to go. You have to understand the connection between win rate, position size, and the impacts on your account balance. So doesn't it make more sense to risk more when your win rate is high than when your trading strategy only has a win rate of, let's say, 50-50 or less, 30% win rate? A lower win rate means that you're going to have more losses. Therefore, the greater your risk per trade, the bigger your swings are going to be in your account balance. It's just simple math, really, is what it comes down to. And it's amazing that I find that I talk to traders, and again, this all comes from my experience in either things that I've done well, mistakes that I've made, or working with other people. And they say, well, I risk 2% on every trade. But if your account balance is constantly changing, then that 2% is always going to wind up being larger or smaller relative to your, to your win rate. So think about that, as it relates to your own personal trading. And some of this may, hit right on you. You say, you know what, I make that mistake. And that's a mistake that a lot of people make. So insight number 3, and this used to get to me a lot, losing streaks happen, and losing streaks are not your fault. It's that scene, it's like that, and I say this, because every time I say it, it reminds me of that scene in the movie in Good Will Hunting with Matt Damon and Robin Williams, and he says, Will, it's not your fault, Will. It's not your fault. It's not your fault, Will. And losing streaks are not your fault. We wear them, most of us wear them on our sleeves. Oh, this isn't for me. I couldn't find a good trade if it slapped me in the face. Or, you just get into a funk and you just can't seem to be on the right side of the trade, on the right side of the market. Just everything you do, you get in that mode where everything you touch just falls apart. And again, sometimes a streak will last longer than other streaks, but they're a part of actively trading the markets. It's just the nature of numbers, right? So, no different than if you were to flip a coin up in the air, you're going to eventually hit streaks where you're going to hit heads 5 times in a row or 6 times in a row. And the more you flip, the longer those streaks mathematically will occur. So streaks are a part of the business, and they're not a result of you being a bad trader. So embrace the mentality of streaks. We talk about win rate. Win rate's a long-term concept. Win rate is not something you can say to me, hey, I had 3 winning trades today. Well, okay, well, let's put that in the perspective of talk to me about the last 6 months or the last year or the last 2 years. So win rate is a long-term concept. So you have to be trading for a certain period of time in order to at least evaluate, what is a fair win rate. In the short term, tomorrow, the day after, anything can happen. And losing streaks, like I said, are not, unless you're just clearly doing things wrong, or you're not going in with a plan, or you don't have the right foundation, or you're just winging it and hoping for the best, then a streak is going to happen on both sides of it. You don't want to lose your head. You don't want to freak out. You don't want to throw in the towel. You don't want to, but you do have to recognize when a streak is occurring. And if your foundation is good and your process is good, in the long run, it'll just be a small, dip to what is ultimately a longer, success. And those losing streaks will end. So I want to highlight this just numerically. So again, this is just for example purposes, and you can back your own numbers into this. I really do believe that good traders are no different. They run their trading, and I learned this the hard way, that you have to run your trading like a business. Like you own, a sneaker store, and you have to keep inventory, and you have to have records and books and records of what you do, so that you know exactly what's coming in and going out, and how the numbers are working. If you're not looking at the numbers of your trading business, if you're not evaluating, how you did today, how you did this week, how you're doing over the month in terms of success rate, winners, losers, break even, average gains, average losses, that kind of thing, and you're not keeping a diligent record of that, then you're not on top of your business, and you're just kind of throwing caution to the wind. I'm telling you, that's a mistake. Those that succeed in trading and in any business know the numbers. They know themselves, because what happens is it's not about the numbers themselves. It's that you're training your brain to think in terms of numbers and probabilities and outcomes, so that you are developing a process and methodology, and you're looking at the science behind what you do, rather than trading off of impulse. Those that trade with math behind them, they quantify their outcome, they go in with a plan, they have everything mapped out in a nice, neat package, are going to be the ones that succeed in the long run, because they're approaching their business with a thought process, and that thought process will last a lot longer. Your ability to stay in the market, whether it's a bull market, a bear market, whatever it may be, is going to be based on the science of your business. If your business isn't getting results, you're going to know it, and you're going to be able to say, okay, what's a matter that I'm not getting results? And then you're going to say, well, my win rate's not that high. I need to work on my win rate. What am I doing wrong? So then you can drill down on specific areas that are posing red flags so that you can work on those specific areas. Maybe you're doing something wrong. Maybe you need help. Maybe you need to work on something. Maybe your approach. Maybe you're not, as well versed in what you do as you think you are. And this was, again, just me. You don't know. Most traders, it's the unconscious incompetence. You don't even know what you don't know. So how do you expect to get ahead? Think about it for a second. You don't even know what you don't know. And most people, whether it's your own personal ego or your stubbornness, they think they know everything. They think their approach is the right approach. But if your numbers don't dictate it, numbers don't lie. People lie, numbers don't lie. So I'm a big numbers guy when it comes to looking at your trading. So in the screen here, based on a 60% win rate, which yes is a very high win rate, you can see even six trades in a row will occur every 245 trades. So for every 6 trades you make, you're probably going to have 2 losers in a row. For every 16 trades you make, you're probably going to have 3 losers in a row. And so scales the streak. For every 245 trades you make, you're going to have 6 losers in a row. And this is the streak of consecutive losers in a row. So understand that the numbers of the losing streaks are going to scale higher relative to how active you are in the market. So this is what I mean by really understanding your numbers and taking the time to do the due diligence behind your your approach to trading. And like I said, the goal here is not to say this is the numbers you should have. The goal here is for you to say, hey, I remember what that guy said about streaks and my numbers. Let me go and let me analyze my numbers. Let me start to do the due diligence, so I can determine how do my numbers play out. Where do I fall on my grid? How many trades am I making a month, a year, on average? And start to map out your because you're really going to get what ultimately, like I said, is going to happen. You're going to start to get in touch with the science behind your trading. And it's a shame most people don't do that. I don't know why. Maybe it's just laziness, but just most people don't do it. Number 4, pay attention to position size. Again, another key part here, and this all plays into the risk factor. So in light of the previous evidence that I just showed you, it matters that all matters when it comes down to position sizing. Most traders have a very poor attitude towards the size of which they put on a trade because they don't know about the importance and how it impacts your overall performance. As I just showed you, losing streaks are inevitable, so not adjusting your risk and position size can be very, very costly if you're not aware of those streaks and how they play out. So again, another example table here. So in this example, we're going to take a $10,000 account value, and again, you can put your own numbers in here, and somebody that trades 4%, they put on 4% position size per trade. So when you start to lose, right, so you're risking 4% on a trade, you put on a 400 share size position, you lose, your account's now at 9,600, you continue to put on that same 4% position size, but now because you have $9,600 account balance, you're actually putting on 4.2% in risk, and then you lose. So again, if you hit 6 losers in a row, you go on a losing streak, you can see you're actually losing a lot more money because you're not adjusting your position size relative to the account size. So when you do hit those streaks, it's important to know so that you can scale down your position sizing. Again, just another situational type thing to think about so that you can make sure that what happens is when that streak ends, it's going to take you a lot longer to dig out of this hole than it will to dig out of a hole where you're actually proactive with adjusting your position sizing as a result of those losing streaks and or your account balance. Again, this is just kind of very, very top level, make you think about it, in theory, but again, if you're trading 50 times a day, it's a harder thing to do. But if you're like most of us and you're not trading 50 times a day, and you're trading maybe once a day or 3 times a day or a few times a week or a few times a month, it's very, very important that you you know, and if you're going to go with this approach of a 4% position size or a 2%, or you can insert any number you want relative to your own personal, you know, risk profile. This is the way that I have found to be the most successful, because you're going to mitigate your risk by being proactive with your, like I said, with your position size. Now, I just showed you what it looks like on the, you know, if you're not managing position size correctly. Now let's take a look at what it looks like, you know, the right way. So again, managing with the same 4%, notice how your position size changes when you hit that losing streak. So, and most people say to me, well, you don't know you're in a losing streak till you lose 4 in a row or 3 in a row. But you should really adjust your position size almost after every trade. So, you know, if your account balance is changing, you know, dramatically, again, if your account balance is 10,000 to 10,000, you know, 75, again, just kind of put this in a I'm just giving you a nice, you know, simple concept here. And what it does is, you know, like I said, you're going to recover faster when your losing streaks are over, and the psychological pressure is going to be less because you're limiting your losses, and you're not increasing the risk while you're in a losing streak, which, as we all know, being in a losing streak sucks, and it's mentally challenging as it is. So you're just making it harder psychologically when you're not being proactive about managing risk. And most people think that managing risk is just, well, how much are you willing to lose? Well, that's not the case. Being proactive with risk is understanding how you should size into a trade relative to, you know, your own risk profile. If your risk profile is 2%, 1%, 5%, 4%, whatever it may be, make sure that your position size is reflective of that. So again, this is just general insights that, you know, that I find to be very, very helpful for people that are, you know, more on the novice side. I'd say if you're sub 2 years of experience, or, you know, even 2 years, post 2 years of experience, but you have no results. Again, trading is one of the few businesses in the world where it's a true meritocracy. It doesn't matter what you know about trading. If you can recite to me the Encyclopedia of Technical Analysis, you have wasted your time. This is a performance-based business, and you are judged solely on how you perform. If you don't make money, but you know a lot about trading, that's just useless knowledge, in my opinion. And I know people that know tons of information about trading. They can tell me stochastics and all types of indicators, oscillators, you know, patterns, moving averages, you name it. They can spew the information, you know, quicker than I can blink. But when asked if they make money, well, the answer is, well, not yet, or no, not really. You know, and that's what matters most, unfortunately, when you're judged in performance. So, you know, I focus on the things that I think really matter. Simplicity in the language of price, up, down, sideways, and again, there are ways to corral the probabilities of what should happen. And again, it's not an exact science. We're not trying to be 90% right. Being right, you know, if you're focusing on being right, you're not focusing on being a trader. Being a trader is focusing on risks and probabilities, not being right. Nobody cares if you're right. Care how much money you make at the end of the year or how your performance is. And that's really what matters most. So my job is to get you to think in terms of the things that really matter at the end of the day, because reality is reality. And as a trader, our product at the end of the day isn't how much knowledge you have. The product at the end of the day is how much money did you make. So it's easy to get caught up in all the jibber jabber, as I say, of trading. But when you really, you know, buckle down and you focus on how to get results, again, that's where I think, you know, I excel, because I do have, you know, 20 years or whatever, 17 years of real experience. I've not only built an education company around it, the education company came after, you know, I built a trading company. And I have a trading company that has north of 700 traders in it. So, you know, if there is somebody that knows what they're doing and does know, you know, kind of what it boils down to, I think I definitely have that notch under my belt. Not to say I know everything, and again, there's always somebody smarter than me, but truth be told, you know, what matters most is a trader's performance. That's really the thing that I think, you know, everybody should care the most about. Whoop, I missed a slide. Adjusting your position size helps avoid psychological problems and also makes recovering from losing streaks easier. Again, just kind of restating what I've already said. Okay, so the last part, emotions in check, and that's a question mark, and I'm asking you, are your emotions in check? And this is something that I don't know where I got it. Somebody sent it to me. I can't take the credit for it, but I thought it was really funny and kind of spot on. And it talks about, the things that traders say. And I hear this all the time, being on a trading floor for years of my life and even saying some of these things myself. And again, I'll let you kind of read through it, take a few minutes, and it kind of, what you say is a reflection of what you do, and being aware of the things that come out of your mouth is very, very important, because if you find yourself pointing the finger and you're one of those traders, and and I hear it all the time, oh, it's the damn black boxes, or it's the computers, or it turned on me so fast, or whatever it may be, it's basically the human way of emoting, whether it's greed or fear or ignorance, or what I call H plus W plus P. That's the hoping and wishing and praying combo. That's the deadliest. If you find yourself hoping, wishing, or praying for an outcome, and the formula I tell people is H plus W plus P equals E. Hoping plus wishing plus praying equals exit the position. It means you have no business being in the trade. You don't know what you're doing, and even if you wind up lucky is not a skill. And again, these are just little insights that I just wanted to pass along, because I think a lot of this is going to be applicable to you. If you're honest with yourself, and good traders have to be honest with themselves. It's very easy to get caught up in the, you think you're better than you really are, or you don't want to admit that you're not as good as you think you are. I see that all the time, unfortunately. You want to be, in your mind, you think you're at a certain level, but the reality of the numbers, again, the numbers don't lie, don't speak to you being at that level. And my traders, are very, very in touch with their numbers. We break out our numbers at T3 for our traders, in terms of performance by the minute and even by the hour, by the day of the week. Every which way we analyze those numbers. And I think that it's something that every trader has to look at to kind of start or end their day, if not both. So that really, our understanding of the things they're doing well, whether they're making money on the long side or the short side, or however you're looking at your numbers, and the more you can break that out, like I said, the more on top of your business you're going to be, and the better I think the outcome you're going to get. So if you're into trading, if you're into trading to make money, which is the only reason I think we're all here, you have to treat it like a job, like a business. Your trading has to be repetitive, it has to be dull, it has to be boring. If you find yourself getting excited during trading sessions, or you're cheerleading, or you're going home miserable, you're really not thinking in terms of being professional, but you're really more what I call a hobby gambler. Trading is an activity of dealing with probabilities, where you know that the correct combination of risk reward and the win rate will make you, end up ahead. Again, it's a long-term process, but again, I use the word process very, very actively, because it is a process. And if you're not thinking in terms of this way, and you don't know what your process is, or you don't have a process, that's where you need to have that intervention and say, look, if I'm going to go any further with this, then I need to have a process. And I'm no different. After 3 years of making money because I was lucky in the market, I realized after 3 years I had no process. And if there was any chance of me actually developing a business, a career, making any money ever again, if I didn't get a process and a foundation and a methodology for how I was going to approach the markets week in, week out, day in, day out, there was not going to be a next year or a year after or 5 years from now. And it's funny, I say this all the time, because I think it's just so simple, but it's so true. Most people gauge, successful traders, they say, oh, that guy made a lot of money trading, or he's a successful trader. But in my mind, what makes somebody successful in trading is longevity. Get to 10 years, get to 15 years, get to 20 years. If you can get to that point, you're doing something right. You're moving in the right direction. It's not about how much money you make this month or next year or whatever it is in some short period of time. It's how am I going to get to 5 years from now? What is my trading going to look like 5 years from now? Close your eyes and meditate and think about that concept. 10 years from now, what do I want to look like? How am I realistically going to get it there? So in your head, you envision where you want to go, assuming you keep it realistic. And then you got to think to yourself, okay, well, what steps do I need to take to get it there? And does my trading today reflect the process that I need to take to get it there in 5 years or 10 years. So to me, successful trading isn't about how much money you make. I know plenty of people that made a lot of money that aren't traders anymore because they either lost it all or they had no process, so eventually they threw in the towel. They couldn't get to the 5-year or 10-year mark because their business was really built more around, luck and or hoping that the market would act in a certain accord forever. So as we all know, and if we've been around for, a few months or a few years, you'll know that markets change, and if you don't change with them and adapt, then you really don't have a process, and longevity is not really a most likely outcome. And again, I'm just repeating what I'm saying, and I did it on purpose. Trading has to be repetitive, hence the repetitive slide. Every day you come in, you look, at least for me, I look for the exact same things. They may have different symbols. One day it may be this stock, ABC, the next day it may be DEF, whatever it may be, but it's a repetitive process. And again, I'm not trying to break it down that there's no work involved. There's a ton of work. I probably cycle through, hundreds of symbols over the course of any week, but it's a repetitive process. And I do the same things day in and day out, and I know that those things get results because I have the numbers to support that. And again, if you're looking for excitement, and entertainment, trading is not it. Trading, it may exude excitement because it's the money business. At the end of the day, your product usually is some sort of P&L, either a gain or a loss, and that for some reason people think that's exciting. But trading is a rational, emotionless, and you do the same things over and over. Now, when I say emotionless, I put that in quotation marks because it doesn't mean you're void of emotion. We're not void of them. If we were without emotion, we would be dead. It means that we are in control of our emotions. We're aware of our our high points and our low points, and we find a way to come back to that center point where we don't go too far to the right or too far to the left. We do our best to try to keep that healthy balance. So let's talk a little bit, just a few minutes, about what I do, because I've kind of alluded to the fact that I do this. And what I do is T3 Live. I do a lot of things. But one of the things I do is I manage a long-short equities portfolio, a model portfolio that we call Off the Charts, and it's a newsletter. It's delivered every night at 7 p.m. It basically takes my approach to trading and I give it out. Now, some people use it as a research tool. They like my trading ideas. Some people use it as a tool for running their own trade. They're following me, and some people, the day traders, tend to look for stocks that break out, as there tend to be decent breakout plays, both long and short, that they use to find one-day wonders or one-day day trade. So different strokes for different folks, and to me, again, it's just all I've done is take what I did, for what I've done for most of my trading career, and basically package it up and make it pretty so that I could share my information and my research with you. And basically, what it looks like is you'll see a long-short table. This is again an example. Now, this particular picture was taken a while back. There was probably at the time 18, 15 short ideas on here with entry, stop, exit, target prices. Whether the trade was open, whether it was pending, what the closing price and percentage change of that trade was when they when the company reports earnings, because I don't hold stocks through earnings, and then the visual. Every night I do a video. I cover every single trade idea, so you get to watch usually about 10 to 15 minutes a night of just trade overview, where the trade is, whether we're moving stops, trailing stops, what we're doing with the trade. So I make it more narrative than just an email. I send out email alerts, text alerts throughout the course of the day, SMS text alerts. If we want to sell a stock, if there's a new trade I want to enter, so I'm trying to get obviously as the markets are moving, I'm trying to identify opportunities. And if I jump over to my screen here, let's take a look, and we can go over to my, we can just bring up some charts. Here's a couple of trades we're in right now. We're long this energy name, Southwest Energy. The entry price was 24. We bought this one actually yesterday on the pullback. through to 24, and today you can see trading up a little bit. We're also looking at AK Steel. Again, just triggered. The entry's 450. I'm looking for this thing to turn up for a trade up to 540. So in the what you're going to see with me is that you're going to trade. You're going to get the ability to trade stocks that are $4 in price. We also shorted Google today at 550. That was the entry price here. You can see the entry is 550. So I was looking for the bounce. We got the bounce today. It actually traded as high as 550.16, and then traded lower. So the entry price was 550. So you can see that I will trade pretty much just about anything, so long as it's liquid. Whether it's $500 in price or $5 in price, I'll trade anything and everything in between, because to me it's just, it's pictures on a page, and the picture tells a story, and all I'm trying to do is analyze, like I said, the language of price, so that I can identify where it's a low risk opportunity, whether it's long or short, and that's pretty much what I do on a day-to-day basis.